On Point with Craig's Investment Partners.
All right, good morning, everybody. Before we begin, remember the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. And for more information on what we do in that regard, you can contact us via our website or many other ways, but you can find all those methods of communication on our website, and the website address is craigsip.com. Okay, lots to cover. A big week last week, a big week coming up. So let's get stuck into it straight away. First of all, let's talk about market movements. And last week was a pretty good one for most share markets. The S&P 500 in the US was up 1.6%. So US shares actually sitting at a 9-month high at the moment. The Stock 600 in Europe also up 0.7%. The Aussie market up 0.5%, and the UK market flat. So most of the global markets, all of them, in fact, in positive territory. Even the UK, even though it was only up marginally, it was ever so slightly up. The local market also posted a very solid gain. We were up 1.3%, so we're at a 3-month high at the moment. And the NZX 50 index has now rebounded 14.3% since the June 2022 lows, which means the market is still below its peak, its all-time high, which came in January 2021. But we have seen a strong rebound. The rebound's been going for a good 9 months now. So it's been a pleasing performance that we've seen from the local market, which is up 5.5% so far this year. There were some very big movers last week, which did push the index up. Serco had a very strong week, up nearly 40%. On the back of a great result that was well ahead of expectations. Ryman Healthcare was the other high-profile company, at least, to announce a result, and that was a much better than expected result. Pleasingly for shareholders that have had a difficult ride in the last year or two with Ryman, which has had to raise capital for the first time, and it was a lot of capital. The result was very good. And the stock responded positively. It was up 12.4% last week. So great for one of our market heavyweights that has found itself in a bit of difficulty in recent times to get back on track and to return to the strong sort of performances that we've become accustomed to. So it was good news all round for share investors. The real action came in bond markets and fixed income markets, both here and offshore. So here in New Zealand, our 2-year swap rate, that's a wholesale interest rate, it surged from 4.92 to 5.49. That's a massive move in 1 week. The 5-year swap rate rose from 4.25 to 4.61, so not quite as big a move, but still a very big move. So both of those rates, the 5-year rate, the 2-year rate and the 5-year rate, both at the highest in more than 2 months. And the move that we saw on Thursday and Friday in the wake of the budget, at least in the 2-year rate, was the biggest 2-day increase that we've seen since October. I think that was probably the case for both, actually. So it was a hefty increase that we saw. And because of that, you saw fixed income prices, bond prices decline. Prices for fixed income securities and bonds move inversely to yields and interest rates. So interest rates go up, the price goes down of those existing bonds that are out there in the market because you'll potentially be able to buy a bond in the future at the current rates, which are higher and it'll look better. So the older ones don't look quite as attractive in a relative sense. And when interest rates are falling, bond prices tend to go up because those ones that you've locked in the past all of a sudden look better. So we had interest rates up and we had bond prices down. That was partly due to the budget, which I'll talk about shortly, but it wasn't only due to the budget. We've seen those moves across the world as well. Global interest rates have moved higher. We had the US 2-year Treasury yield increase from 4% up to 4.3%. We had the 10-year yield rise from 3.5 to 3.7. So both those rates, the 2 and the 10-year Treasury yields, are sitting at the highest levels we've seen since early March. So it was a very eventful week. The budget was the key thing that we had here in New Zealand. Obviously, came out on Thursday afternoon at 2 o'clock, and I won't dwell on the detail because there's lots of things you can read out there in the media that have talked to exactly what we saw and who benefited and so forth. But to just hit some of those headline issues from the perspective of financial markets and what it means for growth and inflation and interest rates, and therefore the housing market and the share market and so forth. Long story short, the budget was a lot more generous and a lot more expansionary than people had expected. We've had a slower economy in recent months, so the tax take has been a bit lower, so less money coming in the door, and at the same time, we've seen expenditure in the budget, both operational expenditure as well as capital expenditure. So that's sort of the investment side of things as well as just the day-to-day running costs of the economy. Expenditure across the board higher than what was foreshadowed in December when we last sort of got an update. So less money coming in the door, more money going out the door than expected, and that means we'll need to borrow more. So the Treasury or the Debt Management Office will need to issue 120 billion of New Zealand government bonds over the next 4 years, and that's about 20 billion more than people had previously expected them to issue. So the operating balance, deficit or surplus, we're expected to return to surface in 2025, 2026. That's later than usual. Net debt expected to rise to 22% of GDP. Before declining to 18.4. That's up from what was projected in December, 21.4 and 14.1. Remember the government changed the way they measure that. So if you look at the old way it was measured, net debt will be rising to 43%, 43.1% next year, which is higher than expected. So a more stimulative budget, that is good and bad. On the one hand, it's likely to be a positive economic driver. When you put a more generous budget with more spending, more money going out into the economy, more sort of support for families with the sort of early childhood education sort of costs going down to 2-year-olds and so forth, you roll all that and all the other things out across the economy, you've got positive economic drivers, good for activity, good for growth, and obviously migration has been the other big story of late. When you put those two things alongside each other, we have had quite a change in the expected outlook over the last couple of weeks, and that could actually see us avoid recession. There's been a lot of talk about recession. All the economists predicting it, the Reserve Bank predicting it, the Treasury had been predicting it. They're not anymore. These new numbers that the Treasury put out with the budget suggests that we'll avoid recession. We won't grow super strong, and we won't avoid it by much, but we will avoid those 3 quarters of negative growth that they had penciled in for June, September, and December. They now see all those quarters being positive. So there's a good side to that. The other side of that coin, as always, more activity, more growth, more happening in the economy. That's obviously inflationary, isn't it? And that's why you had that market response in terms of interest rates rising. The market sees inflation. It sees this budget as a expansionary one, a stimulatory one, good for growth, good for activity, not good from an inflation perspective because it will fuel inflation. And that's why you saw interest rates go up, and that's why you saw expectations and forecasts for where the Reserve Bank will take the OCR. We saw those change as well. So this is all really interesting because we've got a Reserve Bank monetary policy statement coming up in a couple of days on Wednesday afternoon. But cast your mind back 10 days, 14 days, a couple of weeks ago, everyone was very sure that the official cash rate would peak at 5.5%. At the moment, it's at 5.25%. Everyone had been expecting one more increase this week, which would take it from 5.25% to to 5.5, and that was expected to be the top, as high as it gets, and from there it sort of plateaus, goes sideways, and eventually comes down. And that was in fact what the Reserve Bank itself had in its numbers too. Now, because we've seen not only the budget, mostly the budget, but also we've had another month's worth of migration data, and that's looking super strong, which again, good for growth, good for activity, not so good for inflation. But that and the budget, which much more expansionary than expected, those two things have changed people's thinking. So now financial markets, instead of seeing the OCR peaking at 5.5%, they see it peaking at either 5.75% or 6%. The odds are sort of 50-50. So the market definitely sees it higher than before. Maybe getting to 6, maybe not quite there, but certainly sees more OCR hikes than it saw before. And thinking ahead to this week, while everyone was very confident in the view that we'll just get a 25 basis point hike this week, that's that. Nothing to see here. It's virtually a done deal. Now, markets actually see an outside chance. I say outside chance, but it's sort of to the tune of 35-40%, an outside chance of a 50 basis point hike this week, which the Reserve Bank might do. We'll talk about that shortly, but that was the big one of the week, the budget. We were all expecting it to be a reasonably frugal one, the no frills budget. That's how it had been sort of pitched in the lead up. It wasn't a no frills budget. It was a relatively generous election year budget. So that's good and bad, depending on your perspective and depending on sort of whether you benefit. There'll be plenty of people out there saying this is fantastic. From a political perspective, I think the most astute thing in there was the inclusion of the 2-year-olds in the 23 hours for early childhood. That is a smart political move. That is really hitting that medium voter, those young families, parents in their 30s and 40s, little kids, got the mortgage, starting to really feel the pinch because of higher mortgage rates. Those people are what you'd call sort of a centre voter, a medium voter, as they call it in political science terms. And that group, some of that group, I'm sure, will be swayed by that policy. It's a broad-ranging policy. So, whether you agree or disagree from an economic perspective about whether it's the right thing to do in the current environment and whether that's where money should be being spent, from a political perspective, it's an astute move. Dairy prices, that was the only other thing locally. Prices fell. We've had a couple of good auctions now, but they slipped back a little bit last week, not dramatically, 0.9%. So more of the same. Internationally, it was also relatively quiet. We had some Chinese activity indicators, and as I think I suggested a week ago, they did point to slowing momentum. China has come out firing this year. The economy is storming ahead after a very slow 2022. But they obviously can't keep that pace of growth up. So things are still looking solid. You've still got year-on-year growth across all of those indicators that China releases on a monthly basis. But that's partly because, you're comparing them to a weak period a year ago, and we are seeing the pace of the rebound start to taper off. So, it's not a bad thing. But, we are starting to see a bit of a tapering off in growth. Right, what are we watching in the week ahead? There's, as always, plenty to watch. Let's start with out there in the big wide world. Flash PMIs for May are due this week. PMI stands for Purchasing Managers Index. So these are essentially surveys about activity, about cost pressures, order flow, all of those sorts of things. One of my favorite economic indicators, because they're always very forward-looking. We get them earlier than everything else, and they tell you a lot about sentiment and what's happening sort of, right at the minute. So it's a very sort of finger on your pulse type indicator. We'll get the Aussie one first on Tuesday, 11 o'clock. Japan later that day at 12:30, just after lunch. that evening and overnight, the UK, Europe, and the US. So these will be fascinating. These will cover May. They'll be one of the first indicators from May. Obviously interesting, given the current environment and outlook and what you're seeing across markets. In recent months, they've looked pretty good. We've had an economic expansion across the board. However, we've also seen an increasing divergence between the manufacturing sector and the services sector. So manufacturing has been weak, services have been super strong. When you look at all those PMIs at the composite level, which kind of combines both, they look great. But if you isolate the manufacturing sector, they look pretty terrible. If you look at services, they look very good. So lots to watch. We'll also be watching some of the inflationary trends. They have been less encouraging of late. In the last month or two, we've seen some of those inflation pressures pick up, input costs pick up, wage pressures still very high in the services sector. That's in the US and in Europe. So I think that's just a reminder that even though we've generally seen inflation rates come down, there's still a few things to, we're not out of the woods yet. So we need to focus on those things as well. The other big one globally will be the PCE inflation readings out of the US. These will cover the month of April. PCE stands for Personal Consumption Expenditures. It's just a different type of inflation measure. It's important because it's the Federal Reserve's preferred inflation measure. So I think price pressures will remain elevated, but we should see a general trend of slowing inflation as we've seen in recent months. So markets are expecting the headline PCE to increase 0.3% for the month, and the core PCE actually to rise by that same degree. So at an annual level, the headline PCE probably come in at 4.3. Which would be up slightly from last month, although only slightly. Last month 4.2, so 4.3 is not a big uplift, and that's still, apart from February, the lowest since June 2021. It's still well down from the peak last year in June of about 7. And the core PCE, similar story. It was 4.6% last month. It'll probably be the same. That's the equal lowest since late 2021 and down from February last year where it was 5.4. So I think that will just tell us that, look, inflation has come down, but it's still stubbornly high. It's still not coming down as quickly as we would like. We'll be watching the debt ceiling. That's in the US, the debt ceiling debate. So looking for news flow on that. House Speaker and the House of Representatives in the US Congress, Kevin McCarthy, noted that a vote could happen next week. So we're watching any news there. What will be the compromises that the two sides of the political spectrum in the US need to concede. Can they sort of find a way to compromise to get something done? Obviously, it's all coming to a head probably next week. So that's an important one from a sentiment perspective. And the US markets are very calm, and you're not sort of seeing any reaction at the moment, but they will be expecting to see a deal done or an agreement reached. So if we're still sitting here in a week's time and we haven't seen any movement, then that calm might not be what is out there. You could see a bit more volatility across markets. So that's definitely an important one for us to keep an eye on. On the local front, it'll be the Reserve Bank. So this Wednesday, we will get the OCR decision and the monetary policy statement. So 2:00 on Wednesday, that all gets released. Then there's a press conference. So, I sort of covered it at the start. We're at 5.25. We've hiked the OCR 11 times this cycle. There's another increase coming this week, but we don't know if it's the 25 basis points we were expecting a fortnight ago or a week ago, or if they go for something bigger because of what you saw in the budget. So that will be closely watched, and the forecasts and projections that we get in the monetary policy statement will also be very important. So the last one we saw was back in February. The Reserve Bank was still forecasting a recession later this year. So again, have they changed their tune like the Treasury has, or do they still see a recession ahead? That will be interesting. And where do they see the OCR going? Before, back in February, they thought the peak would be 5.5%. Now, if that's still the case, this week is the last one because they're at 5.25. So even if they go for the small 0.25% hike, that would take them to 5.5, which is what they told us in February was as high as it gets. So if they stick with that forecast, this week is the last OCR hike. But markets obviously have had the luxury of responding to that new information, and the Reserve Bank only puts out this new forecast pack every few months. So we want to see how has their thinking changed since the budget, since that the strength in migration. And I don't even know whether they'll have been able to factor that in. The budget was only on Thursday, and they've probably finished putting together all their material, their forecasts, and going through sort of all the checks and balances and the process they need to go through to do that forecasting. That all of that material, so maybe they won't even have been able to factor it in. Who knows? We'll be looking for clarification on that in the statement we get and during the press conference. So that will be super interesting as well. It's a really important week with that Reserve Bank announcement, the clear highlight. Also quite a bit on the corporate front. Had those results last week, Ryman being a good one, Serco being the one that drove a big share price reaction, and there's more to come this week too. Lots of companies with results coming: Gentrack, Infratil, Kiwi Property, Napier Port, Oceania Healthcare. The two big ones are Mainfreight on Thursday and Fisher & Paykel Healthcare on Friday. Two of our genuine market heavyweights. Those will both be really important and really interesting. So Mainfreight Thursday, FPH on Friday. Busy week on the corporate front. Internationally, again, we're in wind down mode for the international reporting season. There was a couple of results last week, but it's mostly done and dusted. A couple to watch though. Nvidia will be interesting. Obviously, that it's the chip maker. Had a bit of an up and down last few years, but in recent times it's just been surging ahead, powering ahead, and I think a lot of that is on the excitement over AI and what that could potentially mean for demand for Nvidia's products. So that stock's just been on a tear. It'll be really interesting to keep tabs on their result, which comes out in the US on Wednesday. So you won't hear about it till Thursday here. Outside of Nvidia, Intuit, that's sort of a company in the UK that's in the same space as Xero. Lowe's, they're in the retail sector. Best Buy, Costco. Costco's a big one. A lot of people follow Costco. They're out on Thursday. And a handful of others too. So there are a few things to watch. I think what I'll be watching most closely, apart from sort of just the way markets trade, really, we've seen a very calm share market, but we've seen lots of moves in bond markets. So that's really interesting. I'll be watching those two things. The PMIs will be interesting. The US inflation figures will be interesting. Be obviously watching for any news flow on the debt ceiling, and the Reserve Bank here on Wednesday will take centre stage. If you're interested in the NRL fantasy update, I did get the win last week, so that was good. I've got 2 in a row under my belt. So Devon just steamrolled through him last week. That was pleasing. It's going to be a lot tougher for me this week. I've got injury worries in my team, and you can't win this competition when you've only got less players, obviously. So Chats is probably going to get the win over me this week. He should be happy about that, and he should be pleased about that. It's sort of not a real win, and it's probably an empty victory that he'll be celebrating, having had extra players. But whatever. I guess that's what'll go down in the history books, won't it? So good on your Chats. You've done well. That's all from me. I will record another podcast over the next couple of days. Got a couple of topics in mind, so keep an eye out. But other than that, thanks for listening. Have fun out there. Take care. It's a calm market, but it almost feels a little too calm, given all the things that are going on. So that's actually what I might make my next podcast episode about, because there are a few things we need to keep out for, and this current period of quiet might not last too much longer, depending on how things play out. So enjoy your week, and we'll talk again soon.
For more insights, visit craigsip.com.